All right, let's kick off. Thank you everyone for joining today. We've got a big business risk review webinar to get through. As you can see, I'm in the office. My internet was playing up at home, so I made a mad dash into the office. For those of you wondering, I am in the office, but I do have my mask to put on as soon as I'm finished with this webinar. So today we're going through the business risk review for June, and there's plenty happening. As always, with COVID about, things change very quickly. You can put a wrap on a presentation or a report, and of course, things can change within 24 hours, which is certainly what we've seen. We've seen a lot of changes in the last couple of weeks with the New South Wales and Greater Sydney outbreak. So I will touch on that a bit, but just keep in mind these are numbers for June. So be gentle if anything seems to contradict exactly what we're going through, as we are at the 15th of July, as we know. But anyway, we will touch on that. CreditorWatch product suite, as the majority of you hopefully know, we've got a full suite of commercial credit reporting solutions and tools, from onboarding new clients. So we help you onboard clients, do away with paper-based credit applications, and utilize an online credit reporting solution, which we apply ASIC, and that will automate, entity verification, signatures, anything to do with client onboarding. Obviously, setup, monitoring, alerts, scoring, all of that. Full suite. Not going to touch on it today. That's not why we're here. If you do have questions, please let us know. We can go into that. Key highlights that I like to show as well. Going through all sorts of data here. We've got a huge amount of data that we're bringing in from various sources and crunching it on a live and daily basis. Big chunk of that coming from our customers, and then of course our connections into government portals like ASIC, APSA, PPSR, all of that sort of thing. So gives us the ability to push out a huge amount of insights, which of course leads into business risk review, and that's how we're able to sort of talk about what we're seeing, what we're expecting to see as well. So a few extra things that I've added into the business risk review, which will become part of it, part of the norm going forward. Economic insights that I've pinched from our chief economist, Harley Dale. So thank you for that, Harley. Of course, payment defaults, court actions, external administrations, probability of default, which is something new that we've reported on the last couple of months. Got a bit of a July stats teaser because we're starting to see a few things happen really late June, and that's made its way into July as well. So I will touch on that. Of course, any questions that you might have, please don't be shy. Please ask them in the GoToWebinar control panel that you have access to, and I will try to get to them towards the end or at the end of the session today. As always, we are recording the session, and we will send out the slides within sort of 24 hours as well. Kind of touched on the business risk review. We pull all the data together from all of these various sources. Importantly, the big one that I'll talk about today is payment defaults, what we're seeing there, and administrations. Plenty of information coming through, which is really important. So let's kick it off with a general sort of economic insights review here. So what do we know? Good things, lots of good things happening. Pre the Sydney outbreak, the country was flying. We'd moved on from lockdowns and border closures. The vaccine rollout, though slow, at least is moving, and everything was looking quite rosy. So the Australian economy grew faster over the first half of this year than certainly anyone anticipated. And I always say that where we found ourselves towards the end of June was in a best case scenario that, even the most probably optimistic economists probably didn't have in their best case scenario bucket back in June 2020 last year. Interest rates look set to remain at very low rates for the foreseeable future, despite plenty of economic commentators and journalists out there sniping from the sidelines saying that they have to go up very soon. The RBA has really doubled and tripled down on the fact that we won't see an increase for a couple of years, which is great news. Unemployment rate is falling faster than anyone anticipated. There are more Australians employed than before the pandemic, which is a huge, huge success. If you dig below the surface, however, the CreditorWatch Business Risk Review is starting to show a couple of cracks. There's some key leading indicators of delinquency starting to peer through, green shoots, whatever sort of example you would like to use. They are starting to come. We've entered 2021 in much better shape than we first expected, but of course, we have a long way to go. If we look at the last sort of 2 weeks, there's a huge amount of negative news out there, and I've sort of stopped having the news on in the morning while I'm having breakfast and trying to sort of not avoid it. I'm not naive, but it can certainly get to you, particularly if you're living in Sydney. You know, it's gone from good to bad to worse to worsening, and everyone's got an opinion. So confidence, positivity is really important. However, you know, the next 2-3 weeks will certainly be extremely telling in Sydney and what that means for the rest of the country. So ultimately, we are going through the worst economic shock in the life anybody has experienced. We're certainly not over it, and relativity only counts for so much. You know, you see, you know, the tens of thousands of people attending Wimbledon and the Euro final at Wembley, and then you see, you know, festivals going on in the US and whatnot, and you know, it's very easy to sort of focus on those, and you see the vaccine rates of those countries as well, which is really disappointing. Ultimately, we find ourselves in a place that Melbourne found itself in 12 months ago, and you've got to go, how did we find ourselves here again? How did we make either the same mistakes or not set up processes to avoid this? So it is challenging, but we've just got to get on with it. Ultimately, there's nothing we can do as individuals in the short term, other than, you know, for those in Greater Sydney to stay home and only go out for essential services. However, we know that that's going to have a tremendous impact on the New South Wales economy and, of course, the national economy. New South Wales really were the ones pulling more than their fair share through the last, you know, 12 to 16 months. Not only in bringing more Australians home, but also having not really experienced any significant lockdowns. You know, we were contributing far more from a GDP and economic output point of view than any of the other states. So this will certainly put a lot of pressure on the economy as a whole, not just in New South Wales, but nationally. But in good news, we know that, you know, Victoria, fingers crossed, there's a tiny little blip with those, you know, little outbreak that they've got down there. Hopefully it doesn't go much further. We know that Victoria and Queensland and, of course, WA are really starting to do well from an economic standpoint. So hopefully they can, you know, shift the load that New South Wales has taken over the last, you know, 12 to 16 months and now start pulling their fair share and more. Economic growth, I think everyone's probably seen this or similar graphs over the last few months. You know, the economic growth, quarterly growth here, this is for GDP, is exceptional. I think the same, we're expecting to see really good growth still for the June quarter because it was essentially unaffected by this Sydney lockdown. And then it will be interesting to see, you know, what happens over the next few weeks and how we get out of it in Sydney, and what sort of impact that'll have on the July, August, September quarter from a GDP perspective. All right, getting to some really good news. Credit inquiries for June. 18.6% increase in June 21 versus June 20. We've seen not an increase versus May, but still well above, you know, where we were last year, which is fantastic news. This is really, for me, the heartbeat of commercial trade, whether it's, you know, finance inquiries or B2B trade credit inquiries. This is a really good evidence of businesses applying for credit and businesses providing credit at all levels, all states, all industries. So it's a really positive news story. People are getting on with it. Got to live with the current situation that we find ourselves in. There will be hiccups, hurdles, bumps along the way, such as what we're seeing in Sydney, but ultimately this is where we find ourselves. We can't sit around and wait for 80-90% of the nation to be vaccinated before we get on with business. So this is really positive. The more this continues, at least in this either upwards or within this sort of space, the better. And June, remember, while it's come down from May, there are other school holidays that were sort of around that period, and that always slows things down a touch. Payment defaults. Now, this is the really important one. What are we seeing here? So May to June, there was a 15% increase, which is quite significant, but still down on June last year. And June last year was well down on June 2019. Actually, next webinar, I might start comparing 21 to 20 and then comparing that to 2019 as well, that what we would call the pre-COVID numbers. So while still down on last year, we've seen an increase again. That's 3 months in a row that we've seen increases of payment defaults. Now, we've been talking about the fact that we would expect to see an increase in payment defaults continue in a nice sustained fashion, and that is certainly happened. We haven't seen any large increases. However, the fact that we've seen 3 months in a row is really good support that people are getting back to their normal sort of collection rhythms and collection routines. Big question mark is what will happen in July now that we've seen this lockdown happen in Greater Sydney. Typically, rationally, you would go, well, we'll see, another increase because, people will be struggling to pay their bills. But as we saw through 2020, Australian creditors tend to look after their customers, their colleagues, their friends, their family, etc. And will probably pull back on the number of defaults that they actually register, which is, a false positive essentially, because we know without, the same sort of JobKeeper stimulus being pumped into the economy and the insolvency protections that were introduced last year, businesses are really on their knees, particularly small businesses. They are really hurting out there. Any business that's reliant on foot traffic in particular is absolutely being hammered at the moment. So it is really, really tough to see, and we can only hold out hope that we do get out of this in 2 weeks. I think that's really a best case scenario, and unfortunately what we're likely to see, even if we do see an improvement over those next 2 weeks, is that we won't go back to totally unrestricted working and living conditions. There will be extended conditions around number of people in venues, whether you can stand up at the pub and have a beer, restaurants, indoor dining versus outdoor dining, all those sorts of things that obviously still heap pressure on businesses that are trying to get back to normal. So payment defaults, definitely a really important one to watch. 3 months in a row that we have seen increases, and a 15% increase from May to June. Court actions has been, still well down everywhere bar WA. Obviously, WA pretty much getting back to normal over there. New South Wales, we're 50% down on this time last year. Vic 24% down, and Queensland 24% down. And we know that last year was well down on pre-COVID numbers as well. Overall, almost 36% down. Nationally, huge backlogs of court cases to get through. Lockdowns in each state obviously contribute to this even more, and of course the COVID restrictions put in place slow down court action. So this is not a great one to look at from a future indicator perspective. The other really important thing to note here is that the banks and the ATO are the biggest contributors to court actions. Obviously, they are the biggest creditors in Australia by volume and value. They are certainly not back to their normal collection rhythms. The ATO won't get back to that normal collection rhythm that we're used to for quite some time, and I would say particularly with New South Wales now in lockdown. And a federal election to come at some stage in the next 6 to 12 months. We probably won't see that until after the federal election, and that goes similarly for administrations as well. Those two parties, banks and ATO, contribute a huge percentage of insolvency notices and external administrations. Until they get back to doing what they were doing pre-COVID, we won't see a huge increase back up to those pre-COVID numbers that you can see at the left-hand side of this graph, which is obviously well over, that 800 mark. 750 to 800 mark is really the litmus test to know that we're back to a normal sort of trading condition. Coupled in there, not just the banks and the ATO responsible for those numbers, but of course, the fact is that there's still plenty of synthetic liquidity in the market, propping businesses up. However, we are seeing overall increases in administrations when you start to look at it on a trend line. It is still up and down, March up and May up there, and then of course we've seen it come off again in June. However, the big thing there, and I've circled it there was a 75% increase from week 3 to week 4 in June. So that was week commencing, I think it was 14th to week commencing 23rd. There was a 75% increase. And the majority of those were creditor related administrations, I'm pretty sure, having had a look at the stats yesterday. So that'll be a really interesting one to watch. 75% increase. Obviously, if that trend continues, we're going to see an avalanche of administrations, but 1 week is not a trend, so we will keep an eye on that a little bit closer. We haven't seen the same sort of numbers come through. However, we'll have a look at that over a longer period of time rather than week to week. But that's the big number that I sort of pulled out from an administration perspective, week to week in late June. Looking at it by states, New South Wales still leading the way, as they always do. One of the stats that I ran was looking at the numbers to the end of June. So essentially financial year 21 versus financial year 20, and comparing the percentage of administrations in Victoria versus those 2 years, to have a look at, okay, Victoria's done it the hardest, arguably, over the COVID period. Have they been affected? Have we seen them start to account for more administrations on an overall basis? And the answer is no. I think there was like a 1% increase. So despite the really extended lockdown in Victoria, we haven't seen them start to increase the number of administrations that they usually would have contributed on an annual basis. So it's something that I will keep watching and I will keep running to see if it makes a difference. But for the time being, the numbers are all very much sort of in line with what they were doing pre-COVID as well. A couple of stats here on the right: 22% decrease in June 21 versus May 21, and a 21% decrease in June 21 versus June 2020. So despite there being plenty of businesses out there that probably should have gone into administration, we're still not seeing those sustained increases, but there is a trend line heading north very gently if you were to look at the first 6 months of the year. All right, having a look at probability of default in June. So this is a new one that we've done. I think this is probably the 3rd month in a row. It jumps around a little bit, but essentially what we're doing is utilizing the new CreditorWatch, or it's not new now, it's probably 9 or 10 months old, the CreditorWatch risk score. That if you are a CreditorWatch customer, you can obviously see that within a credit report. It's either included in your package or you can order them on a 1-by-1 basis. And within that, you get a probability of default of the entity, but also the industry that entity exists in. In this case, we're pulling it from a high level and just saying this is the probability of default for the industry. Probably no surprise here, accommodation and food services, the riskiest one. They're usually more risky than most in pre-COVID times, but certainly with everything going on during COVID, we've seen an increase in accommodation and food service probability of default, closing in on 6%. And if you were to look at that in CBD areas, particularly if you were to look at cafes, restaurants in Sydney CBD, that would certainly be increased or a lot higher than what you would see with cafes and restaurants in potentially suburban parts of Brisbane or Perth, for example. So this is looking at it from a national level. You could start to really drill down and use some common sense around, there's less people in the CBD. How is that state or that particular city doing, and start to get a better sense of how likely or unlikely we are to see defaults in a particular industry, in a particular area. Transport, postal, warehousing, they've done it tough the last 12 months as well. Notable ones in the middle there, retail and construction, not a huge change. And next month, I will start to do some comparisons month to month as well, so we can have a look at that to see if any ones are moving a lot. But other than that, I think that starts to give you a better sense of, what industry you're dealing with, or industries that you're dealing with, and start to really understand how they are performing on a monthly basis. So a bit of a teaser here. Obviously July, as I touched on, admins seeing a 75% increase in that last week in June. What will happen in July? Defaults, we've seen 3 months in a row of defaults, including a 15% increase from May to June. The Sydney lockdown is certainly going to have a tremendous effect, particularly as businesses simply don't have the same sort of protections from a safe harbour perspective, nor do they have the same sort of stimulus being supported by the government in the way that JobKeeper did. There is the stimulus being introduced, but it's certainly not the same as what we saw during JobKeeper. So there's big question marks around the survivability of businesses, particularly those either reliant on foot traffic or unable to get staff and ultimately serve customers as well. Something we have coming in the future, it'll either be next month or potentially in September, is we'll start to look at how businesses are being paid, and specifically looking at small versus large. We know that if you're a large business, you're a critical supplier, you're more likely to be paid on time or close to on time, compared to you being a small business, a non-critical supplier, a supplier that a debtor could easily supply or hop around to your competitors. There's some really interesting stats coming out there to see that small businesses are paid that much slower than larger organizations. So some fantastic numbers that I'll be able to share with you hopefully in the next month or two, so keep an eye out for that. Of course, the payment rating, this is done a soft launch just to customers at the moment with brand new payment rating. It used to be called the payment predictor. It's been replaced with the payment rating. So starting to align that more with the credit risk score that we introduced last year, late towards the end of last year. And what's really interesting here is we've rather than just providing the average number of days overdue that an entity or an industry is paying, we start to group them into payment rating buckets A, B, C, D, and E, making it much easier to I guess assess exactly how you can expect a particular entity to trade with you and ultimately pay their bills, and then you can assess the risk associated with that. And whether you want to offer things like 7-day, 14-day terms, or potentially start them on COD because they are a slower payer than usual. So if you haven't had a look at that and you are a customer, jump in and have a look, either order one or speak to one of our customer success teams or your account manager to talk you through that in more detail. Or you can jump on the blog, which I will jump over to and show you. We've got some details on the payment rating here, which you can go through. Here's the rating bucket. So A, they're paying the majority of their invoices in the last 12 months on time. B, 7 days or less. C, 30 days or less. So that really makes up the vast majority of companies in Australia. And then your D's and E's are 60 days. Around 60 or more. So certainly organizations that you want to avoid offering terms to, or at least be really, really tight or offer, really limited credit limit exposures that you'd ultimately be happy or comfortable missing out on. So please do jump in there and have a look. Any questions? I'm just going to jump in to have a look to see what sort of questions have come through. Bear with me. Yep, good question here. Grant's always got great questions for me. 18.6% increase credit inquiries, but how does this compare against a more normal 2019? I will introduce 2019 numbers into the stats going forward, but I know that we are at record numbers at the moment, so we are well above 2019 numbers. Of course, CreditorWatch has also grown a lot, so we're normalizing those numbers out in connection with the growth that we've obviously seen. Are you seeing increased collection activity from the ATO? Still no. While they are doing their normal collections in terms of calls, emails, and reminders, in the post, they're certainly not getting to the court action winding up administration stages that they would have had in their pre-COVID collection strategy. And as I understand it, they're essentially offering payment, scheduled payment terms and whatnot to anyone who asks for it. So it's very much still Team Australia and being really gentle on the collection perspective. Sorry, I'm going to have a look at a few others. Have you noticed variances in business trends, behaviours between Vic and New South Wales, this prompting the variances to defaults and other trends between the two states? So that probably, from an administration perspective, that's what I went looking for a couple of weeks ago, just to see, have we seen an increase in the number of Victorian companies going into administration versus what we are used to from a proportion perspective? The answer is no. From a default perspective, we're also not seeing that. So nothing is jumping out to say, one state is under more pressure than others. Again, we're still in that sort of synthetic environment that I talk about, whereby there is a huge amount of, government stimulus and liquidity flowing through the market. That is reducing every month. However, then we see a lockdown happen in New South Wales, and that creates another variance in being able to read the numbers. Naturally, creditors stop registering defaults altogether, even if a default is pre-lockdown or pre-COVID related. We're just seeing that organisations don't want to be seen to be registering defaults at a time such as now, and administrations are following a similar sort of journey there. We're not seeing an increase in those too much. There's a question here around probability of default. The best thing to do, asking about what is the base example over what term is this looked at? The best thing to do is probably jump on the website, and there's information around how the risk score is put together. What I can do though is get back in additional information with you around how the score is put together in the first place, and then of course how we come up with the probability of default goes into that. And we've done 45-minute webinar on this before, so I'm not going to try to answer it in the next couple of minutes, but I will get some information to you. What is the current position with release of ATO data to credit reporting bureaus? We were having really good conversations with the ATO about 6 months ago, but that has gone quiet again. We're due to hear back from them. I think the challenge for them is it ultimately becomes an optics issue for them. They don't want to be seen to be releasing information, even if it's right at the end of their collection process, where the person or the company rather or directors haven't made contact with the ATO for 12 months, and then it's a significantly overdue and a significant figure. I think ultimately from an optics perspective, they're probably holding back, but we were hoping to start getting that information any time from sort of now onwards. But I will come back with an update, hopefully in future webinars, once we've got a little bit more information from the ATO on that. What do you suggest to do with customers that refuse to sign contracts? Look, quite an open-ended question. Obviously depends on, you know, what's in the contract, credit limit, your terms, those sort of things. But ultimately, if a customer is not willing to sign a, you know, credit application, I would strongly be suggesting you review whether you want to deal with a customer that doesn't want to sign it. It makes it very difficult to commence collection or legal activity down the track if you've got nothing signed and there's no contract in place. It's also certainly a red flag. I'm sure you know, most people in credit and finance would back me up on that one. Just on that again, if it's happy for you to we might reach out to you directly and we can sort of chat about that in a little bit more detail, Rob, particularly if we want to get into, you know, PPSR discussions as well. But I'll come back to you on that one. Do payment default stats refer to past due or registered defaults and past to collection? So our payment defaults can be registered by our CreditorWatch customers on their debtors when a debt is overdue. Some creditors, some of our customers choose to register that, you know, 7 days overdue. That would be a small proportion. I would imagine that the majority of defaults being registered are being registered, you know, towards the end of their collection cycle, where emails, phone calls have been ignored or scheduled payments have been missed. It could be, I know that some of our clients will refer it to debt collectors, and then the debt collectors have a go and then they register a default. There's no sort of one answer to that. You know, it's really up to the creditor to decide when they register the defaults. However, I will add that registering defaults is a powerful collection tool, and it's a great way to actually get paid, particularly for those debtors out there who are, you know, avoiding contact with you or regularly missing scheduled payments if you put them on a payment plan of sorts. Do I have any insights into the backlog of court actions? No, I don't, but it's a good question. I might make a note to go back to that and have a look to see if we can find any stats. Having had a look at the court listings just last week for Sydney, there's certainly no spaces in the court date. So I think you know, it's not a case of not getting through them. There's just so many of them that are backlogged from particularly last year, and the COVID restrictions just limiting the number that they can get through. All right, as always, just a really couple of polls so we can continue to improve our webinars. In this case, just a question around when is the preferred time that we run these webinars. We have, you know, traditionally done them at 12:30. We've been doing some at 11:30 as well. Always good to get an indication of what your preference is. I would have guessed 12:30, but the numbers coming through here are suggesting definitely the other way around. So that's really good to hear. So I'll give that another 5 seconds before I close that poll. Looks like it's fairly conclusive. We're at almost 90% of people prefer 11:30 time slot. So that is good to know. It means we can all get to lunch and have something to eat, which makes total sense. So thank you for that. And the last one, as always, do you want to be contacted by a team member at CreditorWatch? It could be about anything. It could be about your existing account. It could be something that I've discussed today. It could be an economic question. Just say yes if you do and no if you don't. Don't be shy to put no, that is fine. This is a really good way for us to sort of prioritize who we speak to and give people and customers and prospects and visitors and webinar attendees the ability to engage with us as well. We like to get feedback too. So don't be shy to jump on the website and get any information that you need or get in contact with us as well. All right, thank you for that. Majority of you have voted. So that takes us to the end of the webinar today. I just wanted to say a big thank you again for joining us. Plenty happening. We're getting to the point where, we've got enough data coming in and it's changing sometimes very regularly that we could run these on a fortnightly basis. We won't do that to you though. We won't do that to me. As always, thanks again for joining us. And we've got plenty of new webinars, exciting content coming up on the blog as well. So don't be shy, jump on there, have a look. And of course, we're always keen to hear back from you. Maybe next time around, I'll run a poll and ask what you would like to hear about outside of the outside of the business risk review webinars, whether it's PPSR, insolvency, Phoenix activity, credit reporting in general. So signing off today, thanks very much for your time. Stay safe if you're in Sydney, and stay safe if you're anywhere, to be honest. Thanks again. See you later.